Saw an unusual trade in Nike ahead of earnings tomorrow, and it looks like we already have a question about it. So that's going to be one of the things we talk about today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic. So, yeah, Ranjana Gupta already asked us a question about Nike, but I happen to have been looking at that beforehand. One of the reasons was because we saw some unusual trading activity. Now, there were two sort of big trades that I saw. One was earlier in the day and one a little bit more recent. Let's take a look at both of these. There's some consistency in both of them, I think, in terms of where they see the stock going. First things first, this stock has moved pretty sharply over the course of the last 8 reported quarters. I think the average move, we can double check this, is about 10%. That's being skewed a little bit by the fact that the last quarterly earnings release saw a particularly big move, 15% in one day. I think it was almost 20 in just a couple of days. So what were the two big trades that we saw today? One of them is a trade that I've become a little bit more interested in lately. This is just because I am beginning to wonder whether the equity rally is getting a little bit long in the tooth. And that doesn't necessarily mean sell everything, but it does mean that I think we should arguably be less ambitious about what stocks might be able to potentially do in the future. Now, in Nike's case, this is a little bit different. The reason it's different is because Nike has sold off so sharply. It's I'm going to just throw up a 5-year chart here so we get some sense of it. So you can see that this thing was $180. We're actually just under it. Back at the tail end of 2021. So 4 years ago, stock was almost $180. Now it's $70. So what were the two trades that I saw today? Well, the first one was a long-dated call sale. It was the September 2026 90 strike calls. Those were sold for about $3.40. It was a pretty big trade, too. It was 6,000, as you can see right here. Now, if we look at that trade, basically what that's telling you is that this is somebody who does not believe that the stock is going to be able to recoup its losses, is not going to break out to new 52-week highs, or at least it's not going to exceed the 52-week highs that we've seen right now over the course of the next year. So that basically means the highs are in. The highs over the last 52 weeks are basically going to be the highs for the next 52. That's essentially what that trade is saying. I suspect that that is against long stock. So that would look a little bit like this. So if we just said, okay, so you're going to be long stock. I'm going to just flip this. Long stock and then short a call. Now, why is this trade a little bit more interesting to me now? I think these longer dated buy rights become more interesting if you think that there's kind of a limit to what the stock could potentially do and you're willing to give yourself a little bit of a boost. A lot of damage has been done here. $3.40 a share, which is what this trader collected on the sale of those options, amounts to about 5% of the current stock price. And 5%, especially over the course of a year, may not sound like much, but maybe to somebody who has a long-term hold on the stock, they might say, whatever my performance is, if I get 500 bips of relative outperformance, because I really, really don't think the stock's going to exceed 90, and or if it does, I'm happy to sell it there, then I guess you could kind of see where this trade is coming from. Personally, I'm a little bit more in favor of these long-dated buy rights, kind of like the one that I had outlined in strategy as an example. From the beginning of this year, where you can sell a 20% out of the money call and then get a huge amount of premium. We can examine that one a little bit more closely in a second. The other trade I saw was in some ways even more unusual. Don't see a lot of these. It was a big 1/3 ratio. And what happened there was somebody was trading the October, this is the regular way. So regular way expiration. They were buying the 75 calls. And then they were selling the 87.5 calls, but they were doing so on a 1/3 ratio. So this is really, the scale of that's not all that helpful. But the gist of this is, now the trade, let's see what prices this thing assumes you could get that off for. And let's take a look. So, yeah, the trade that they put it on for, they paid, I think, $1.32 for the 75s, and then sold 8,000 of the 87.5s at 20, and another 4,000 at 21 cents. So, you know, call it a, we'll call it 20 cents and figure the rest went to transaction costs, right? So that's going to be, they're collecting $240,000 in premium on the short 87.5s, and then they spent, at least by my work, about $528,000 on the 75s. So net spending about $275,000. Now, what was interesting about this is that once again, it's kind of targeting that 90 level, saying no chance, no how. Now, granted, this is much shorter in terms of how far off it is, because this is only expiring in just over 2 weeks. But in either case, this is a situation where, and who knows, you know, I mean, could be the same institutional trader. Seems a little unlikely, but in any case, it's sort of looking at 90 as an upside limit. In one case, an upside limit within the next couple of weeks. In the other, as the upside limit over the course of the next year. I would not probably go into that long-term buy rate. Oops, I put that in too many times. That's supposed to be 1 by 3. There we go. Should look like that. This other trade, though, you know, maybe. It's a little risky to be net short 2 calls up at 87.5. But that's a good way higher than where the stock is right now. 25% higher. And, you know, it doesn't really seem to me like there's a really good case for it to rally to fresh 52-week highs here. So I think that's, you know, something to think about for those of you who are looking at the stock. So let's see, where's my financials? Why didn't that come up? Did I just type the wrong? Huh. Oh, whoops. Not going to get many financials on the call options. Got to look at the stock. Something else I was thinking about as I was looking at this was, okay, I have a hard time getting around the valuation for the business just based on the forecasts, right? So we're looking at the street estimate is for $1.67 adjusted for the full year. That's 42 times. What would be a reasonable number? You know, what gets you to $70 or 80 or 90? You know, where do we think, okay, that seems like a reasonable number? All right, well, let's say for the sake of argument that we wanted to throw a market multiple on it, 25 times. Okay, so what would that mean? Well, 70 divided by 25, that gets us to 280 a share. Next year's forecast is for 247. You know, I can say that that's, you know, is it within the realm of possibility? I suppose. I mean, you know, that's only a 7% margin. We've seen higher margins than that, although I think I've previously said on one of these live streams that I think the peak margins that we saw back in the sort of post-pandemic era are probably not realistic. But even if we got to this kind of, if the revenue numbers are right, $48.5 billion, what does it take for us to get to 280 a share so that this becomes a reasonable multiple? Only slightly broader margins than what the street forecast is here. So, and then you can either look at it and say, well, maybe revenues come in slightly better, margins come in slightly better. So it could be some mix of these things. Essentially, what all I'm trying to do here is say, I don't really see it. I'm not all that enthused about Nike, but what would encourage those that are taking bullish bets, whether it's the person who's putting on this 1x3, they clearly are just expecting a good positive result. It's not a long-term investment, just expecting a better than expected number and for the stock to outperform coming out of it. The SEP 90s, on the other hand, if those are what I think they are, which is basically a covered call against the long, that is sort of going more where I'm talking about. You have to be looking for a number, that's probably better than the $2.50, so that you would need to get some kind of indication from management when they report tomorrow that number, that the street's estimate is a bit on the conservative side, before I would start to get enthusiastic about it here. And look, consumer names, I'm not terribly enamored. I also happen to, just because I was talking to a former colleague about it as we were looking at this, I was looking at LULU, simply because I think it is getting cheapish on a fundamental basis, but technically it's still quite broken. Take a look at that. But I do have my eye on it. My friend was pointing out that he sort of saw it catching a bid here, even though Decker's numbers were maybe a little bit less than what people had been hoping for. I don't really see it. I'd really like to see it sort of bottom out a little bit longer before I think that this downtrend has broken. It does seem reasonable, though, to think that it could potentially fill this gap in here. Let's just take a look at a 1 year so you can see what that gap is that I'm referring to right here. Right? So, but it's going to take a little bit for that to happen. So, hope that's helpful on the... Oh, yes, sorry. Ranjana Gupta was asking about a specific trade. Let's pull this one up and see what we think of this. Well, first, let's take a look at the term structure, because what you're looking at is an Occ-Jan strangle swap, 60-80, and we want to see a really steep backward. It's a pretty steep backwardation, actually. So, okay, now let's load that trade up. Well, this is in the hunt, to be sure. This is the Occ. Oh, no, it's not quite as much. These Occ-17s, 54, almost 55 vol. Looks like a potential candidate. So let's build this one in, have a peek. So if we go to January and we load in the 60-80, we've got the 60s in here. Put the 80s in here as well. Buy both of these. And then we're going to sell some Occs against it. Occ regular way. Were these Occ regular? Oh no, you have Occ 24. Okay, so I like that. A little more vague in him. Sort of playing for a little bit more of the vol crush. So, and these were the 60s. Okay. And that's not supposed to be like that. It's supposed to be like that. Okay, so what's the cost on this thing? $3.30. Yeah, $3.30. Okay. Now the expected move, as I said, was about 10% by the end of the week. The expected move, which we can actually calculate by taking a look at the Occ 24th straddle. So we'll just look at the 70 calls and puts together and see what that works out to. Oops. 1440. I might, let's see what happens if we push these strikes out just a little bit more. I don't know that they have to be 14 bucks away, but let's just here's the issue. So that call is 1% of the stock price, and that put is, just over 0.5%. It's okay. It's okay, but I kind of feel like only okay. I'd really like to see. I mean, this thing has really moved a lot, right? So on earnings recently, and you got somebody who's long the 75s, short the 87.5. So they obviously think that 80's in play. Probably wouldn't do that trade if you didn't think that would happen. And it doesn't have to run through that. Just runs through that 75 call, and that 80 is going to end up looking like a not so delightful sale. And actually, here's a good question: that valley of death on the strangle swap. That's you're referring to this bit here. So what that isn't necessarily telling us is how much of a vol crush we might expect to get. Let me just take a look and see if I have that in another system. Just really quickly, I can pull it up. Do we have the vol crush in here? I was not worried too much about this percentile. I'm really more interested in this number over here, which is the implied volatility, the change before and after. So like we said, we were looking at in the 50s down to 30. So that's kind of the instantaneous win that you're hoping to get straight away. Yeah, I mean, I guess it's all right. I guess part of my lukewarm or tepid response to it is that, number one, collecting $1.24 on a $70 stock that has moved on average, if it moves just its average amount this week, this thing could swing $6 or $7 by Friday. So the notion that I'm going to capitalize on collecting $1.30 or so, I like those kinds of trades when I really do suspect that, we could stay within these ranges. Now, I mean, in fairness, $60 is a good downside move. I mean, that's almost $10 and $10 to the upside. So yeah, I mean, I think it's okay. I will say this: if you put this trade on and it runs to the upside, which is clearly what that 1x3 trader is betting on, and I would assume that the person in the covered call is hoping, I would cover the put side quickly, because I have a feeling that those longer dated puts will probably start to come in pretty steeply thereafter too. Especially if you follow earnings, you get a good upside move, and it sort of settles in for a few days, because at that point, some of that immediate concern to the downside is probably going to be mitigated. And I've certainly seen that kind of thing happen, where there is a vol crush in the longer dated options in that scenario, where a big concern, because I mean, look at the stock. I mean, it's just been in this prolonged downtrend, so those things are kind of in everybody's frame of view. But if something came out that sort of said, oh, okay, maybe that's the worst is off the table, those will probably start to come in. So I hope that is helpful, Ranjana. Thanks for coming back. FinWest, thanks for reviewing costs last week in advance of earnings. Your consideration of getting at least 1% a month nearly pinned the put strike exactly. Yeah. It's look, this is the thing, right? If you're going to take an equity risk, you want an equity-like return. Now, granted, in the case of selling downside puts in Costco, there's kind of a high multiple there. So I think your approach, because I remember your trade was, to my initial response, quite far out of the money. Doesn't need to be quite that far. But if I remember correctly, we were, what was it, like 3 on the 800s or something like that. Not a whole lot of premium relative to the strike price, but certainly a very high probability of profit. But, Okay, Michael Kane. Hi, Mike. A while ago, you had mentioned MSTY. Since then, it has traded down with the downtrend in Bitcoin and MicroStrategy. Do you still like this investment? So strategy, interestingly, has indeed been underperforming Bitcoin. You know, it's a levered play. Viewers will know that I like Bitcoin, also like Ethereum. The difficulty for me here is that I actually now have a relationship with the company that manages that ETF, so I can no longer, shall we say, speak freely about it. This isn't anything other than these are securities, and because I'm associated with the manager, that I think it could be construed as, you know, selling securities or something like that. So I have to be a little bit careful about what I say about them. I will say this, that is that, you know, the trend lately hasn't been that great for Bitcoin, but I'm not terribly concerned about a huge amount of weakness between now and the end of the year. That's the first thing I will say. The second thing I will say is that I still like, and probably a lot of my trade recommendations have suggested, being net short options premium. We had a big pullback earlier this year, as Carter Worth pointed out to me just a couple of days ago. Said, you know, it's rather rare in the absence of some profound catalyst to get significant drawdowns, you know, stacked up one on top of another in rapid succession, and he therefore feels that you know, the rally remains intact through year end. I had previously said, I think at the end of August and early September, we're now at the end of September, that if we made it through the end of September, past the FOMC meeting, that I thought we were probably in pretty good shape through the end of the year. So that is also consistent with this. So just in terms of covered call strategies, you know, diversified funds would probably suit that need fairly well. And I still remain bullish Bitcoin. So I hope that's enough flavor that you find that helpful. Finwest, hi from Thailand. Well, hello back. Hope all is well. And yeah, so I see this government shutdown. Is this a possible black swan event? It would not be a black swan event because everybody sort of sees it coming, right? So, you know, we're this is in view. It's a risk that is in view, and I think, you know, the price action suggests that folks believe it's not going to end up, you know, getting shut down. I will say that, boy, this political climate right now is not a conciliatory one on either side, from what I can tell, and that's a little bit concerning. And one wonders whether, you know, recent events are permitting some of these parties to feel empowered to, you know, not negotiate. I hope that's not the case, but it does feel that way a little bit. So not a black swan, but it's a material risk. A government shutdown is not going to be, it's not going to be well thought of, put it to you that way. And you know, I think I'm trying to remember when we have a situation where there was sort of an almost shutdown a while back, and you know, we managed to kind of wade our way through. I'm trying to remember. Somebody else can probably remind and put it into the chat here, but it's not a good idea for us to exhibit that much dysfunction. And I don't think you know, the truth is, I don't think that the president wants that, because it's not going to look that great on the world stage either, I wouldn't think. Hard to project strength when you can't even keep your own government open. Nevertheless, I do think that some of the things that are being asked for are a little bit unreasonable. So, okay. Let's see. Last Saturday, I got a happy anniversary email from IB. It's been 25 years, starting with Timber Hill trading system access over the dial-up modem. So Alex V, I'm not sure. Were you actually, did you work at Timber Hill, or are you just talking about the fact that you've been an IB client for the last 25 years? I'm not sure. And Finwest, I know you were a professional trader at some point, floor guy. So I don't know if you were at Timber, but yeah. And one other thing I would say is that, having gone, when I was in Las Vegas at the Hood Summit and I saw the things that these guys are working on, particularly this thing called Cortex, which is sort of this, intuitive AI application that's sort of built into their platform, where you can just say, I want to do a study that looks like this in plain English, and it'll write it for you. Pretty slick. It's things are advancing very quickly indeed. Oh, whoops. I have a bad habit. I'm always turning this thing on when I shouldn't and off when I shouldn't. That one goes to voicemail. Whoever it is in Sonoma that's calling me. Okay, so LULU has a huge volume on this downtrend. Does that signify everyone is out? It could. I mean, certainly one of the things you want to see if we're looking for, a potential change in direction or anything like that is we want to see some big volumes. That's, the price action is one thing. You want to see volume too. And you can see we certainly got some in here. This is still elevated. Let me shorten this up because I think I'll go to 6 months. There. So you can see we got a big washout in here. 35 million, 37 million traded on that day. So we'll call that 50, 14. What percentage of the float is that? So, yeah, I mean, that is big relative to the shares outstanding. Let's take a look at the short interest also. 8.3% of the float is short also. You can see how high that is. Both S&P and S3, it's not really. So you can see here the S3 score, not crowded. If it's the way they work it, 1 to 39 is not crowded. 40 and above, they're becoming crowded and have a moderate risk for a short squeeze. By S&P's work, you can see the percentages that they have, less than 10%. And in both cases, we're kind of right on the cusp of that next tier. So you see that bump up, and then, I might be inclined to get a little long. So seeing a little bit of the washout volume, plus the potential for a little bit of a squeeze in there. Not a big thing, but it's helpful. Any kind of tailwind you can get for whatever reason. Let's take a look here. What's the expectation for these guys? So we have earnings coming up. First week of December is what they're looking for, and let's take a look at the alternative data really quickly. So Placer has year-on-year foot traffic up more than the industry. Interesting. Observed sales by Bloomberg second measure is worse than the industry in terms of annual growth. But I will say, and in fact I have said on a couple occasions, that I've personally found, this is totally anecdotal, I have no real data to support this, but I will say that from what I've seen, Placer has been a better predictor. I'm assuming that each of these measures is improving steadily over time. So the Bloomberg second measure of today is not the same as the Bloomberg second measure of September 2024. But Placer was better. And, the foot traffic thing, what is it? Is it people? Well, what else could account for it? they're tracking mobile devices. So they can see when people are going into the store. And if they say it's higher, I'm kind of inclined to believe it. It's a big sample too, by the way. It's millions of devices. So, you know, those things are also positive. And you know, we got a little bit of a pop today. So I think there's a couple things that are queuing up in, you know, together that suggest this is one to keep an eye on for sure. Eileen says Nike is selling at Amazon again. I can understand why they left Amazon and why they're back. It'll probably be good for the stock. Look, I mean, the thing that's going to help Nike is if everybody wants their products again. You know, this was the thing that everybody wanted to have. Everyone wanted to have their clothes. Everybody wanted to have their shoes. I can speak from personal experience. My teenage sons, Nike was kind of the hot ticket a couple of years ago. I don't hear about it anymore. In fact, actually, when one of my sons left for school today, he was wearing the ON shoes. My wife was making a comment, "Oh, don't those look good?" This and that. No sense of urgency to own Nike apparel or Nike footwear. I'd kind of like to see that come back. You know, my kids trendsetters? Nah, not necessarily, but you know, in some ways, I don't know that it matters, right? Whether they were trendsetters or they were just followers, you kind of get a sense of what teenagers care about. In my area, at least, they're not crazy about it. You want to see a little bit of demand. That's going to cause better top line and better margins. Better top line and margins get you from that 247 full year adjusted EPS estimate for next year up to the 280 number, which would be a reasonable turn. Sort of justifies the current price, or maybe even something a little bit better. But yeah. Okay, so let's continue on here. Yeah, Tucker D Dog saying the threats of the government shutdown, hardly a black swan. Pigeons, as common as pigeons in the park. Yeah, these days, I mean, we keep getting these threats all the time. But you know, we also have, like I said, this sort of increased intractability and vitriol that's going back and forth, and I'm not sure what is empowering politicians these days to think that they don't need to be conciliatory. In the president's case, one must assume the guy's not running for office again. And so he probably doesn't need, not that he ever acted like he owed a lot of favors to anybody, but I think this is even more true now. You know, he doesn't, not running for re-election, you know, I think he's more interested in just doing the things he wants to do. And really the biggest thing that could happen, in my view, that would encourage some in the administration to work with folks on the other side of the aisle is, you know, just international stuff, just making sure that they're not at a complete impasse here. It's my thinking or expectation. Alex V, online access really started with E-Trade and also White in San Diego. IB started as dial-up to the Timber Hill system. Yeah, I remember the Timber Hill system because, of course, we had Timber Hill traders that we competed with back in the day. There's obviously a couple of you who know exactly who Timber Hill is. For anybody who's watching who doesn't know, Timber Hill is the market-making firm that Thomas Petterfee started. You sometimes see Thomas Petterfee on the news. They actually had him on CNBC when it was announced that Interactive Brokers was going to be added to the S&P 500 several weeks ago. He also got involved in national politics. I think it was in 2016 was one of the first times I saw that he was sort of actively getting involved. I believe he was born and raised in Hungary. He's an immigrant, and you know, he's staunchly anti-communist. Unsurprising, given the fact that he grew up in a communist country and knows what that hardship looks like. Self-made guy. Smart guy, options trader, obviously very quanti, obviously very tech savvy. And his market makers, the Timber Hill market makers, were on the options floors back in the days when there were only 4 of them. So there was the Phillips, the Amex, the P-Coast here in San Francisco, and the CBOE in Chicago. His market makers were among the first to have electronic handheld devices in the crowd. So they actually, when everybody was throwing a lot of paper around, they actually had computers, and they used to play what I called red light, green light, because the Timber Hill traders, basically everything that they were seeing was being, essentially watched from above. And if their machine turned green, that said buy them, and if it said red, then you sold them. So the traders were not really exercising as much discretion, from what I could tell. And that worked in their favor in a couple ways, because the crowds could be a competitive place, and this cut both ways. There were times when traders wanted to get a piece of everything. They thought a trade was attractive, they wanted all of it. And there were times when a trade didn't seem that attractive, and they kind of wanted the risk spread around the crowd. So there was sort of a constant ebb and flow, tug of war, pushing, shoving to see whether people were going to be on a trade when you wanted them to be, or not on a trade when you didn't want them to be. Timber Hill was kind of above that fray, because we kind of recognized that wasn't entirely up to them. If the machine said buy them, then they would, and if it said no, they wouldn't do it. They wouldn't get on the ticket, and they were kind of immune to all of that. So interesting times. And so let's see here. Okay, do you look at SPY or anything on a weekly, monthly chart? At this point on this runaway market, I'm looking at anything for an excuse to justify a short. Yeah, I will tell you that I do. Not SPY usually. I'm usually looking at SPX or the S&P futures, but there's no reason. They're going to look a whole lot like SPY does. And it's interesting because I know, most former professional traders probably didn't think of SPY that much when they were thinking about the market. They would think about the S&P cash or S&P futures. Typically, that's how we generally did it. But I have a lot of friends who are on the buy side only that never sort of worked at a bank. And so they actually do think about the market in terms of SPY. I was kind of surprised when somebody I used to work with at the hedge fund would just start talking about SPY as a market proxy. It was kind of unusual for those of us who came from the dealer side to think that way, but it doesn't really make a difference. It's the same thing. And so the short answer is yes. Generally speaking, the one thing that I would look at is something like RSI. Right, so I would look to see whether the market just felt like it had come too far too fast, and that it might, potentially roll over a bit because it was overbought. The reason I would look at this is because my general view, as all of you will know, is generally that over the long term, stock prices rise, and I've never really done that well trying to pick tops and say, okay, this is it. And I'm not going to say that I'm immune to it. I'm not. I have done it. On a couple of occasions, I've said, all right, that's it. I've got to own some puts here. But it rarely works out because the market doesn't usually decline. Over 30-day period, 60% of the time it's higher. So you're paying money betting on something that usually doesn't happen. And, I feel like looking at something like RSI or some close proxy, maybe the CCI, would be just looking for an excuse to do something is probably not such a great idea. I will say that if you were inclined to do it, I have had better success making my short bets with relatively tight put spreads that have like a 3, 4, 5 to 1 payoff that are out of the money than I have from outrights. So, just something to think about. But again, there are other things that I usually like to look for, like a big uptick in volatility. You know, one of the things that you're going to see generally is that volatility can start to rise because everybody's nervous. Everybody's waiting for the music to stop, and there's this frantic thing that goes on when that happens. I've alluded to this several times that I saw this in, you know, the tech bubble in 99, 2000, that you would get situations where, you know, Cisco would have these breathtaking price gaps from one day to the next. And I think it was trading 200 times earnings or something like that. It was just some insane number. And to me, that just was one more symptom that, you know, it was not a healthy market. We don't actually see that here right now. You know, you can actually kind of look at this chart. You can see that actually the market's continuing to behave in a fairly orderly way. RSI, as it happens, the one thing I would periodically use as my excuse to go out and buy puts, actually would be short here. It initiated a short. When did it do this? Yesterday? Oh, today? I guess. Oh, it was just a liquidation. Oh, yeah, so this just a liquidation, wasn't go short, but see what else we have here. See what are the best performing short indicators that we've got. I mean, any short rate at this point hasn't been performing well. These are basically, you know, commodity channel. It's the same kind of thing, right? So it's you're basically skinning the cat the same way here with CCI as you are with RSI. Yeah, so tight put spreads, small bets if it makes you feel better. We're coming into a period. I mean, October's obviously had some very hot, choppy prior years, but I would also encourage people to remember that those numbers are thrown off by a couple really big isolated events, like the crash in '87, like the failure of Lehman Brothers in 2008. So, although the volatility is typically higher, the average volatility is higher, I'm not saying it's typically higher. And we are actually coming into what's seasonally a strong period for equities, the end of the year, you know, Christmas season. So, yeah, I would small, tight put spreads on S&P would probably be the only way I would really think about doing that. Okay, let's see here. Black Swan events have a retrospective predictability in that people often rationalize and explain it as if it were predictable. Yeah, I think that's true. Everything's obvious in hindsight, isn't it? You know, some of these things, though, I think everybody recognized that there was a problem, but they weren't 100% sure how it was going to play out. So, let's take a look at two different examples of market crashes to illustrate what I'm talking about. In the tech bubble, everybody knew that stock prices were too high. Everybody knew that there were a lot of companies that weren't profitable, that were trading at any valuation, let alone the nosebleed ones that they had that didn't make sense, and that ultimately they were going to collapse. The question was when. In 2008, by contrast, I think it was a little bit different. Everybody knew that home prices felt like they had come too far too fast. But I don't know that it was amply clear to everybody how that was going to play out. I think maybe part of the consensus was, well, home prices are going to fall. You know, that there are certain overheated markets like Florida and maybe Las Vegas at the time, where stock prices are probably not going to continue to go up and may even turn down, which was rare, right? Because the general pattern is that residential home prices in the United States rise. I think what happened in equities was not really on anybody's dance card. I can tell you that I distinctly remember a meeting I had with a friend of mine who ran a family office. Their family office was at the Seagram building, and they called me all in a panic and had me meet them outside. Forgive me if I've told you this story before. And I, was working at 499 Park, or at least that's the Park Avenue side of Cantor Fitzgerald, and I walked down to the Seagram building, and I met them outside. They had just come from a meeting, and I'm not even sure I mind saying who they had been meeting with. I think his name was George Fox. He might have been the manager of a hedge fund called Titan or something like that. I think that might have been the name. I'm not sure. In any case, they were all in a big twit because they were convinced that the world was going to come to an end. This is 2007. And they said, we need you to buy us protection on the S&P immediately. Like, they couldn't even say, let's meet for lunch or come up to the office. They wanted immediate protection. That's how panicked they were. And I said, how far do you think that the S&P could drop? And the answer was 70, 80%. Now, I have to tell you that I absolutely believed that home prices had gone way too far too fast and that there were some problems. But when they told me that, they said, oh, I think it's going to come down 70 or 80%. My initial response was, what are you talking about? I mean, I can still remember just standing there on the sidewalk thinking, what? I mean, what did you just hear that makes you think that that is even in the realm? Now, of course, the S&P did not fall 70 or 80%, but it did get cut in half, basically, right? I mean, what happened was a lot more pronounced than I would have believed was possible when I was standing there. And I'm guessing, because I remember it was 2007, that this was probably, things were starting to come a little bit unglued already. Let's go like this. So the ultimate lows were what? April, March 2009. Let's go to end of April 2009 and take a look. What was the ultimate peak to trough decline there? So they already were starting to see cracks in the credit markets. Now remember that 56%. So not 70 or 80, but better than 50. Netted dividends would probably be a little bit less than that. But yeah, I would not have thought that was possible. I just thought that was, I thought it was a fairly silly suggestion. But I did buy a lot of SPX puts for them, which worked out, it should be said. I think they were December 2008 puts, if memory serves. Part of the reason, by the way, that they were asking to do that was because apparently they couldn't get out of their equities because everybody was throwing up gates, which did indicate a little bit of trouble. I mean, I'll admit that I thought, that's kind of interesting, like that hedge funds wouldn't let you withdraw. They had a lot of money for a family, but it was not a lot of money in the grand scheme of things for a big hedge fund, one would have thought. But of course, if everybody's asking for their money back at the same time, or a lot of people are starting to, they might say, hey, read the contract. The contract says that you can only take out a certain percentage after 3 months, 6 months, whatever. Jay, who's in my ears on the production side, he'll probably remember because he was working at a pretty big hedge fund at the time. You know, maybe he knows a little something about what that looked like. But, yeah, I mean, I think that the Black Swan events, I think that was a black swan for a lot of people. I don't think a lot of people would have believed that the U.S. equity market was going to tank well over 50% because of home mortgages. We just had not recognized the scale. Just everybody knew something was wrong, but how it was going to play out. And maybe some of you did see that really well. It's one of the things I will also say about the banking business that I, with the benefit of hindsight, feel is really a little bit broken, which is that, we were only a floor away from the credit, from basically where all the bond traders were, and I had no clue that things were that screwed up down there. And they weren't telling anybody because as the market started to melt down, they started printing it. Those guys weren't thinking like, oh, the world is coming to an end. They were thinking, oh my God, look at the trading opportunities. They ended up having one of their best years as everything was coming undone. Not even recognizing, by the way, that as a firm, we were also at risk because Ralph Ciaffi was into us for big money at the time, and had Bear Stearns not bailed them out, we could have been taken out. So you put all those things together, and it's just amazing that, all these people in the same building, could have had very different perspectives on what was going on and really weren't talking to each other the way they should. And, you know, I mean, maybe it's just not possible for that to happen. You know, you have a firm with 5,000-6,000 people working there, and everybody's kind of minding their business. It's very easy to, you know, be like a horse with blinders on. And that's kind of the way it was. Or maybe that was just me, but I can't claim that I saw that coming, because I can remember distinctly having somebody telling me that it was coming and saying, no, you're out to lunch. So some people knew, but a lot of people didn't. And I was one of those people that knew something was wrong, but it didn't play out the way I thought it would. This is an interesting point. DJ saying, I would prefer to be long Nike into the World Cup. And that's a good point. You know, yeah, it's a good look. That's yeah, okay. I'd go along with that. And you know, and again, here's where we're at with Nike. They have not turned this ship around. Still trading at a pretty rich multiple, but I've already talked a little bit about what could make it seem like a reasonable one, right? 280 in adjusted EPS for fiscal year 2027. Put 25 turns on that, and that kind of gets us to where we're to the number where you are right now. Anything better than that is gravy, right? So if you thought they were going to do 3 to 320, then you would probably be a buyer here. And there's a little bit of time for that to play out. So, okay, I'll go along. Oh, and I see now. It is after 5 o'clock. So I apologize for this. Oh, yeah. I can take this question real quick. What I was going to say is I'm supposed to, Fast Money has started already, and I'm actually going to be hitting on Fast Money a little bit later. And Kirk, I'll get to your SPY, SPX thing in just a second. I own Apple at 215 and I want to keep it long term. Also sold November, covered call, 245 position. Going in loss. Loss? Going in long? Loss or long? Just want to be sure I understand you. I sold some puts with the same strike and expiration. Your comments, please. So you were long the stock at 215. Stock's 254 now, so that's good. You sold the no covered call at 245, and that's at a loss. Okay, so look, it's not a loss because you're in a covered call position. It just means you made less than you otherwise might have. And now, if you get called out, are you talking about going into a wheel strategy where you would sell the 245s to get in? Yeah, I think that is... Well, I mean, it depends on, is this a taxable account? If it is a taxable account, it might not be advisable to allow yourself to get called out at 245, and you might be better off just rolling that and having a loss on the call side. Not providing any tax advice, but something to think about. It's close to the end of the year. So if you get called out at 245 and you're recently in at 215, you're going to have a $30 short-term capital gain potentially. Maybe not such a great thing. So think about just, eating it on the two. It is a taxable account. Yeah. Oh, okay. Yeah, that's the plan. Good. Yeah, that's the right thing to do. You don't want, you always want to try to handle in the best possible way from a taxable perspective, and just roll up and out. I think it's going to be a good Christmas for them. I have a feel. It looks like these iPhone 17 sales are going to be pretty strong. So I think that's a positive as far as Apple is concerned. And I want to get to this before I have to jump because I'm going on to a show that is on CNBC that is already live. But I do want to talk about this, and I'm going to use SPY as an example. I was talking about using tight put spreads. Now let's just talk a little bit about what I meant by that. So Goldman Sachs did a study a number of years ago where they were saying that if you're looking for a short-term hedge, the best option to own was a 30-day 30 delta put. And so first of all, we'll talk about what that is, but I will tell you that in my own experience, I haven't personally found that when I did make sort of strategic downside bets, that actually worked out so great for me. Instead, I kind of tried to look to similar moneyness and then get into, so that would be something like this, right? Ox 650, 651s, those are right around, in and around 30 deltas. Instead, what I have found actually worked out a little bit better for me was when I would put on a slightly higher, slightly lower spread and look for something that had a decent, like a 4-to-1, 5-to-1 type of payoff. So let's have a peek here and see what these look like right here. So this is $10, 2.5. That's 3-to-1. So let's just bump this down a little bit. What's this thing look like? 650, 30. Yeah, so this one is potentially 20. So that means it's 17. Let's just call it, let's say you paid $3 for this. Just so that we're kind of on the same page, and we'll see where things open tomorrow. So that one's got better than a 5-to-1, right? So that's kind of what I would look for. Typically, I would try to go out about as far and put something like this on. And I just found that the sort of the rate of decay and the effective payoff for these types of trades, worked out as well or better. I actually, it crushes me to even say it, but in 2020, just as I was leaving New York and heading to Park City, early 2020, the last live show we did from the NASDAQ, I put a couple on the SPX, and because I was thinking, this pandemic thing seems a little dodgy. And I got to Park City, and I can remember that, we were meeting up with some friends and going for dinner, and I said, I'm going to put in an order to sell these things off. And those were like a 10-to-1 pair. And I remember thinking, oh, well, if I can, get a quick triple out of it, why not? And so I just threw a limit, and I didn't want to be distracted. I was skiing the next day, whatever. And so I put a limit order to sell them and then just went skiing. And, of course, all hell started breaking loose. We ended up driving home to San Francisco from Park City rather than flying. And I was way too premature just sticking a limit order in there to sell those things. But I will say that, the decay is kind of minimal, so I kind of like that as a trade. Let me just make sure I'm not missing anything really big here. So, yeah, that's the way I would probably play it if I was concerned about a short-term pullback in equities, playing against the possibility of some nonsense in DC. Put a spread on with a decently high payoff. 10-to-1, I haven't found situations where you could get so many of those. I kind of feel like, I've looked a couple of times, I sort of feel like somehow the skews have changed so that they're not quite as attractive. But that's how I would play it. And I wish I could stay with you guys for a little bit longer, but I cannot because I have to bounce and hop on the other show. But I want to thank you all for tuning in. And we're going to have office hours tomorrow at noon Eastern with Mark Guthner and a special guest. We're going to be talking, assuming everything works out, we're going to be talking a little bit about options-based ETFs. I'm not going to mention who the guest is, just in case that person backs out at the last minute. It's always a possibility, but hopefully he does not. And it should be a lively conversation because we don't have exactly the same perspective on everything, but he's a thoughtful, intelligent guy. So assuming we have this conversation, it should be an interesting one. So that one's noon tomorrow, and then, of course, we're going to have open mic again on Wednesday at 4:15. Thank you all very much for watching. Like, subscribe, put your comments below, and we'll see you in the next one. Thanks for watching.